The Winklevoss twins. If you've ever seen that movie, The Social Network, you know who they are, but they're also business people in the crypto space. Talk to me about this IPO. They actually recently increased the pricing to it. What's going on here with this one, and how are investors viewing it?
It's going to be really interesting to see this one play out, Frank. So the exchange is Gemini. It goes all the way back to 2014. Obviously, the Winklevoss twins are some of the earliest investors in crypto. But this exchange really hasn't kept pace with something like a Coinbase in terms of adoption and use and product expansion. So you mentioned the upsizing. They're looking to sell 17 million shares between $24 and $26 a piece. That is, upsized from $17 to $19 range. And this would value the company at $3 billion. The interesting thing about this one is it has been operating at a loss for years, an even bigger one in the first half of this year than in all of 2024. And we've just really seen this surge of interest in IPOs this year, obviously under the Trump administration, which has been so pro-crypto. The Winklevoss brothers are big supporters and mega donors of the Trump administration. So we've seen all of these successful IPOs, and I think it'll be really interesting to see if we can keep that rally sort of going in this particular IPO, even if it has been operating at a loss for all of these years.
All right, so we're seeing more of these companies go public. We're also seeing a lot of companies adopt a strategy that Michael Saylor seems to kind of innovate, at least to some degree. The idea of having a crypto treasury. Friend of CNBC, Dan Ives, he's the chairman of a company that does that. Tom Lee, another friend of CNBC, he's also the chairman. I think we're going to show some of the moves of some of those names. What's going on with that strategy? Is that working out for the coins and for the companies? Are both of those benefiting, or are we seeing some type of divergence?
We're seeing a lot of different things, and I think what you're saying, we've never had so many different ways to get exposure in the public markets to crypto. So it's really interesting. Bitcoin has been lagging. If you look at the spot price over the past month, Solana has really been the outperformer versus ETH, which has been doing quite well because of all of these treasury companies, and definitely versus Bitcoin. I think it's starting to look like the Bitcoin treasury play is not quite working out, and I think that has more to do with the attention on other coins like ETH and Solana, which are, the treasury companies around those coins are still doing very well, and I think it has a lot to do with the initial pop, and that is what we're going to wait to see play out later this year, because you can have all of these companies come onto the market, announce a Bitcoin or an ETH or a Solana treasury strategy, and you see a bunch of investors pour in for that initial rush before it tapers off and people start to take profits. But there are investors like BCGCo and Pantera who are, and Galaxy Digital for that matter, who are backing these really, really big deals because they do think that there are going to be 2 or 3 that last for the long term.
All right. Everybody kind of knows about Ethereum now. A lot of people feel like Wall Street's building on Ethereum. You can build apps on Ethereum. Let's talk about WorldCoin. That's backed by Sam Altman, or again, our friend Dan Ives also. What features does that have? Is it a combination of cryptocurrency and AI? Like, exactly what is it?
It is, I think, what Dan Ives would say is the intersection between AI and blockchain. And so what they're really targeting, it sounds like, and AI is not my realm of expertise, but it sounds like they are looking for this sort of proof of human function. So there is this network.
Proof of human? What's that mean?
And in an increasing world of AI sophistication and bots and scammers and false identities, just a way to prove that anyone who is using the WorldCoin network is actually a real human person. So you get a cryptocurrency in exchange, and it actually echoes something that BlackRock CEO Larry Fink talked about in his annual letter this year, which is, we want the tokenization of all assets in the financial world of the future, but in order to do that, we need to get this digital identity thing under control, and I think that's what they're targeting.
Exhale. Pause. Inhale. Pause.
Good morning to you, live in London. Let us cast our minds forward to US CPI data. We've already established we can't take a lunch break here in Europe today because we have the ECB and US CPI. And US CPI, I mean, we were talking about the short end of the bond market, treasuries. That could be the asset to watch here. What are you watching for?
Yeah, so I think, the idea that the Fed is going to cut interest rates this month is pretty much nailed on at this point. I don't think anybody is expecting anything different. But what we might get if we see a particularly high and surprisingly strong CPI number is the possibility that people take away some of the cuts that are priced in for next year, and so that would lift short-term yields at the 2-year tenor, for example. We've got a lot priced in at this point. We had that big rally in recent days, but we have seen inflation number and jobs data that has been justifying the idea that the Fed needs to get on with it. Maybe Trump's right. But I think it's interesting is to pay attention to what it means to the dollar as well. You know, is that a strong number going to be supportive if we get a lift in those yields, or are we going to see that depreciation trend start to continue?
Is Lizzie Bergen going to have an exciting day in Frankfurt today?
It seems unlikely, doesn't it? I mean,
you're in Frankfurt.
the ECB's not expected to do anything, sit on its hands. Maybe we'll see some changes in the forecast. The inflation target is supposed to be kind of within reach, and the economic outlook. Well, there might be some weakness in there according to Bloomberg Economics, but nothing too exciting there. And I think that, again, so thinking about the euro, people have been watching for a long time. Can it bust out of this recent range, get up to sort of the 120 level, something like that? We're still around 118, I think, thereabouts. You have got the idea that the dollar will weaken if the Fed starts to cut interest rates, and with the ECB on hold as well. But people aren't really expressing it. We've been stuck in that range. So poor old Lizzie, I think, going to have a bit of a boring day.
Round this out, I guess, to other G10 central banks. The Bank of Japan meets next Friday as well. Any fireworks expected there? We had, a headline yesterday that the Bank of Japan is said to see the chance of a hike despite the disruption in politics. Is that where you guys stand?
Yeah, so the market is moving away from that a little bit. It seems that if you look at the rates markets, people starting to move their expectations of when the BOJ next raises interest rates to next year from something priced in for this year. Not everybody agrees. We've got a Citigroup call on the dollar yen, quite aggressively looking for it to go down, several big figures. The idea that the BOJ will still hike this year and that will be supportive for the yen. Again, they were talking about if the Fed is cutting, even if the BOJ stays on hold, it might boost the yen. But if we can get over some of these awkward politics, which the market is sort of thinking its way through, then maybe there's a possibility that the BOJ will be able to get a hike done, and that will be lifting the yen again. But going to have to watch that political sphere pretty carefully, because it's going to be pretty tricky in the next few weeks.
Where politics and central banks collide, I guess. Thank you, Paul Dobson, for joining us with your thoughts on the market.
What we're seeing in the market today is that demand growth is slowing. I think that now 3/4 of the year gone, we're seeing oil demand around 700,000 barrels a day. And on the other hand, we're seeing record oil supply, not just from the unwinding of OPEC cuts that have added about 1.5 million barrels a day since the first quarter through September, but we're also seeing record production in the United States, in Brazil, in Guyana, and Canada. So it's this mismatch between the very strong supply numbers and weaker demand. But what this supply glut so far has largely been absorbed by the market. Crude demand is also at record high in the third quarter due to refinery throughputs, but also direct crude burn. And the surplus in the market has largely been absorbed in inventories where they're having less of an impact on the market, in particular in China for crude oil, but also in gas liquids in the United States. So we're not seeing the surplus piling up in tanks in key markets as of yet, but this is something that we think will shift towards the end of the year.
So Turo, why aren't prices already weakening given the surge of supply?
So prices have been trending lower. We're now near a 3-year low. But there's obviously different factors pushing and pulling the market, as we're saying. On the one hand, we have the surplus emerging in the markets that has so far been absorbed by Chinese stockpiling and inventories elsewhere. But we're also seeing the risk to supply from increased sanctions on Russia and Iran. We're seeing increased tensions in the Middle East at the moment between Israel, Iran, and now with an attack on Qatar. We're also seeing new sanctions on Russia and attacks on infrastructure there. So this is sort of supporting the market at the current moment.
Is OPEC Plus making a mistake, a big mistake, actually, by increasing production further?
Pause.
As we've seen, the market has been able to absorb the increase in production from the OPEC Plus countries so far. And inventories are tight in OECD countries. Crude oil stocks are below the 5-year average. So obviously there is a room for the market to absorb this additional barrels. Then moving forward, it would all depend on the strength of oil demand growth and also at the continued stockpiling by some of the consuming countries.
So when you look at actually what happens next, how much of this, oil surplus, and you were trying to explain some of the dynamics, but how much of the oil surplus will likely be scooped up by China, for example, for strategic reserves going forward?
As we say now, that the oil surplus that we're seeing in our balances of 3 million barrels a day, as we say, it's untenable. There isn't the capacity or the ability for the market to absorb such an increase. China has capacity to continue building oil stocks. We saw from February to August this year about 100 million barrels of crude oil being absorbed by China. So if they continued to purchase oil at the current rate, that will help absorb some of the surplus, but it will be nowhere near the 3 million barrels a day that we are projecting. So there will have to be some adjustments on the supply or demand side to make the market rebalance.
Inhale.
Joel, do you think China ultimately could put actually a floor under prices?
So we are seeing that both China but other consuming countries are quite sensitive to the prices. So when the prices fall, they are increasing demand, not for end-use consumptions, but for storage. So that is, to a sense, a floor. But with the extent of the increase today, we could also see adjustments on the supply side. Prices fall to a lower level. We're seeing U.S. producers in particular adjusting their strategies and growth forecast in response to this well-supplied market and to the lower prices. So you can also see adjustments on this side.
Inhale.
Joel, going forward, do you think this is also the beginning of the end for OPEC's mission of supply management?
Exhale.
We don't think so. Of course, we're seeing now very proactive market management by the OPEC Plus Alliance, and they're meeting on a monthly basis to assess the market situation. Now there's a reset. We have completed the unwinding of the first tranche of production cuts of 2.2 million barrels a day. Now this is the start of the second tranche of 1.65 million barrels a day. But OPEC has only committed to the first increase of 137,000 barrels a day increase in the target from October. The actual increase would be less than what we're seeing, as some countries are already overproducing vis-a-vis their targets by about 1 million barrels a day, and we're seeing other countries are now reaching capacity constraints. So we don't think it's the end of the market management, but it's a different strategy than we've seen over the past few years when non-OPEC Plus countries have been taking all the growth in supply. Now, in moving forward, we're seeing the growth in production being split between OPEC countries and non-OPEC countries.
This data is good for bonds. It's questionable for equities. Equity futures just about unchanged. We'll see if this move sticks, but at the front end of the curve, we're down 6 basis points. And as Lisa pointed out, we're down across the curve. And this is largely because of the way the Federal Reserve Chair set things up. Coming into September, he basically told us the following, that you could have a one-off effect on inflation, but not all at once. And the labour market data was concerning him, which is why we're seeing yields down this morning, because there's much more emphasis on what we're seeing on claims.
And it seems like the idea that you're seeing a pickup in layoffs, to Tiffany's point, raises the question of how companies are adapting to some of the higher input costs. I was looking at some of the specifics here in the CPI print. Airline fares up 5.9% on the monthly basis. So again, it talks about the K-shaped economy and how the Fed is trying to cater to people who cannot afford to pay that. Those who can are.
David Kelly of JP Morgan Asset Management standing by. David, you've been looking at the data. Just want your first reaction, please.
I think both with regard to the CPI and with regard to the claims, everyone should sort of take a deep breath and not overreact to them. On claims, key thing to think about is last week was a week that contained a Monday bank holiday, or a bank holiday called in the UK, but a Monday holiday, Labour Day. The unemployment claims data are notoriously bad in a week that contains a public holiday. They just have never figured out how to seasonally adjust that properly. So I think that's an overshoot on claims, and I would not be surprised to see that number come down next week. Now, it still fits into a mosaic of a slowing labour market, and I don't deny that. I think the economy is gradually grinding to a halt here, but I think that overstates the deterioration in the labour market. And then similarly on inflation, these numbers are very close to in line with what we thought. The big surprises were probably an increase in motor vehicle repair costs, 2.4% month over month. And then, as Lisa was just saying, a 5.9% increase in airline fares. But remember, they fell very sharply over the course of the summer as airline travel was down. Now it's picking up again in this K-shaped economy. So overall, the economy is still moving forward slowly. Inflation's gradually going up. The economy is gradually slowing down. That's what we thought tariffs were going to do. It's going to slow growth and it's going to add to inflation. But I don't think it's nearly as dramatic as either of these numbers suggest this morning.
Well, David, let's just stay on the labour market story, because that seems to be what the market is moving on, at least initially. You think the claims data maybe overstates the weakness? Do you think the step down in payrolls growth overstates the weakness too?
No, I mean, we saw the big down revision yesterday or earlier this week. That was not a surprise. No, I mean, there's weakness. The thing is, as Jay Powell has pointed out, it's a very curious kind of labour market because we're having a huge reduction in labour supply at the same time. So this does not speak of significant labour market weakness. I mean, it's still a tight market. It's still hard to find good people. But I do think it reflects the fact that businesses don't want to hire here. I don't think there's a huge ongoing jump in layoffs, but it's getting harder and harder to find a job because businesses are just frozen because they don't know what the playing field is going to be with regard to tariffs going forward. And I think that is, that's the biggest thing that I think people are ignoring here.
David, a lot of people are hoping that things pick up in 2026, that the growth story gets better, fueled by the rate cuts we're about to see. Speaking of things maybe that we underappreciate, something you've been talking about for a while, this tax bill, the kind of stimulatory effect it might have in 26. Could you just sort of outline that for us this morning?
Absolutely, really important. All these new tax cuts, getting rid of the tax on tips over time, increase the standard deduction and so forth, the SOL tax break, all of them were made retroactive to January 1, 2025. But the IRS has not changed withholding schedules. That means that there's going to be basically a full year's worth of refunds on all of those tax breaks kick in the first few weeks of 2026 or first few months of 2026. That is the equivalent of big stimulus checks. Last year, the average income tax refund was about $3,200. This next year, in 2026, we think it's going to be over $4,000, with 70% of households receiving that. That is like one big stimulus check, one big lump of sugar put into the economy early next year. So if we can get to the first quarter without slipping into recession, there is, there'll be some stimulus there. But I do think that between now and then, the economy is going to be slowing in the fourth quarter.